Peter Eliades with you. Stock Market Cycles update for the week ending Friday, January 31st, and the month ending January 31st. Before we go into anything, and I have some interesting stuff to show you, Bob Prechter told the story about he saw a guy on TV the other day, one of the perennial bulls, saying, well, I mean, the January signal is obviously going to give us a positive signal because we're not going to close below the January low now. I mean, it's going to be a positive January. That's because you could have said that yesterday with a little confidence, because as a matter of fact, we were about 55 or 60 points above the December 31st closing point. So as it turns out, we did not have a positive January. Now, I don't pay too much attention to this bromide. As January goes, so goes the year. But some of the statistical things that you look at, there's a gentleman by the name of Jay Keppel, Kaeppel. Google him and go to his page. He does some great stuff seasonality-wise. He's written a great book on seasonality, was generous and kind enough to mention me in there several times. But his name is Jay Keppel, and he just wrote something a couple of days ago and said, you better hope for the S&P to close above, I think it closed the year out at, today we closed at 32.20. I think it closed the year at 32.30.78, somewhere in that area. So it was obvious yesterday that we were going to have an up January from the close of December, except nothing in the stock market is obvious, okay? So that's my speech. We had a down January in the Dow and in the S&P. Now, this is a chart, if you'll excuse my French, that is going to piss a lot of people off. Why? Because look at it. We were commenting here as we get up to the upper side of this projection in the S&P on January 22nd. And by that time, the Dow and the New York Composite had reached the lower side of their projections finally. What a perfect setup. And we said so at the time with the S&P at the very upper end of its range. So people will look at this, 33.31.11. That was the very upper side of the projection for the S&P, nominal 40-week. The high on the 22nd was 33.37.77. Okay, we blew it by 6.5 points. Well, the projections did. What a fabulous projection. Now, we're not beating any drums yet because this thing could turn around Monday, go straight up, go above the 33.31.11 again. I don't think that's going to happen, but this ticks people off because they don't understand how these crazy lines can call the market. And they sit around and try to figure out the fundamentals all day long. The trade thing with China, the plague that's going throughout the world now, and saying, no, these things don't have anything to do with the market. It's the fundamentals that rule the market. Yeah, okay. Anyway, that's my speech on this chart, and it is going to tick a lot of people off because look at it so far. If we start coming down to 3,100, 3,000 in the next couple of weeks, that's going to look like a pretty darn good upside projection window. All right, what else do I want to show you? Before we start with the projections, let's look at, remember this line on the New York Composite Index? We go all the way back to 2009 with this line, and here it is in 2009. Now, this was interesting. I looked at this in '09 and I said, wow, look at this line. It went a certain number of points under and then immediately turned up. So let's call this the beginning of the importance of this line. Because if you go back from there, the line doesn't maintain too much importance. I don't know how far back we go, but you can see we're back to 96 now, and there's not too much going on. So for 13 years, no, the line was not important. Beginning in 2009, it took on importance. You went well below it, and then every time you came down to it, you found support there. I'm not going to go through all the points with you one by one, but follow it. You come down the line, you find support. If you break it, then the line becomes resistance as you try to rally back up to it. And then again, you break above it, and it becomes support. And so this happened all the way through the last 11 years coming into 2020. It's almost 11 years old from the 2009 bottom. And the reason I bring it up today is we broke above this line in the last month or two or so, almost as much point-wise as we broke below it in 2009. So it's kind of a symmetrical thing. Break that far below it, break this much above it. Now, if we break back below this line again in a convincing manner, then that could be telling us that this could be a pretty important top up here. Let's take a look at it on a closer basis. You'll see where it is today. The black line right here, and we closed below it today after being above it since December 11th. So almost 2 months now, been nicely above it. Today we closed beneath it. So now it becomes important again. Theoretically, if this is bullish in the market, it should be supported at or around this line. So that's something we're going to keep an eye on. Okay, I want to show you something else technical before we get into the cycle projections. This is a chart that I recognized this morning, and it's a great chart. And we had not broken it. There's a shorter term channel here. So what I did was I drew a channel based on the high, the external high of November 4th of last year, and the all-time high on January 22nd. Then I drew a parallel channel going back to the October 3rd low. Now, it's not a great channel because you didn't come down and test it a whole bunch of times, but it can be a potentially important channel because today we broke it. We broke below this channel, which is kind of the slope up for the whole rally since October 3rd. You take those external highs, bring them down to the low where the rally started. We broke below it. At the same time, that was a shorter term channel. Look at this one. This channel is determined by the low on June 3rd of last year, going through the low on October 3rd. So once again, we use the October 3rd low, and then you parallel that at the high on May 1st, okay? And so look what happens. Came up to it, broke decisively above it. Now, when you do that, you came down to it once, kind of tested it in here, didn't quite come down to it, came down and almost tested at this low on January 27th, rallied once again, and now today broke both these channels simultaneously. That should be a negative sign for the market. These channels are not 100%, but they tend to give you pretty good signals. So having broken both of these channels, that could well be telling us that short and intermediate term, the uptrend has been broken. Okay, now let's get to the projections, because that is the meat of this subject and the things that we most want to show you and prove to you our projection software. As you know, we have been very firm in telling you over the past several days. Yesterday we said the market's iffy because you were not getting confirmed downside projections in the S&P, but you were getting them in the New York, which tends to be the most accurate projection generator. So let's take a look at the New York today. Actually, what I want to start with is the DJIA. Let's start with that because there are some very firm opinions being given right now by the DJIA. Okay, let's look at this chart right here on the Dow. Remember, these are closing price projections, and the projections give you closing price projections. In other words, it's a closing price chart that leads to closing price projections. Wow, look at this. This is what happened today. So we closed here yesterday, we closed here today. Can you see what a difference a day makes? This is giving a fabulous downside projection, and it's confirmed below both of those lines. And in order to invalidate it, which can happen, you'd have to get back up over the next couple of days up to the 28,400, 500 level. Now, that's not impossible, but it's 250 points away, and from that point, it, little by little, keeps getting higher and higher. But this is a confirmed projection on the DJIA, 27,433, rounded off to 27,755. That's a long way down, folks. That takes you down to the low that occurred back here in the beginning of December. But this is now a confirmed projection on the DJIA, okay? So we know that for 4. What if we take this projection window and translate it into the next longer offset, which occurred right here? Look, I put the rectangle in. This is where the projection is calling for in the prior chart. Let's zoom in on this and see what we have. So on this one, if we get down into this projection window, now you could get down just around here and not go below both of them and then rally again and say that you met the projection. That's a possibility. But it's more likely that you come into the heart of the projection window. And if you do that, then you start to get significantly lower projections. And I think this is one of the windows here down to around the 26,200 level on the DJIA. So today was a very important day. Let's take a look at the very next chart on the Dow and see that. We've got to go back a little bit to see where our current prices are. Okay, so here we are with the current prices. Now, if you follow through, the great thing about projections, you don't want to do this on a cocky basis or an overconfident basis. What you can do is take the prior projection, put it in a box here, then go to the next chart, the next longer offsets, put that in there and say, and that way you can do a running count of where the projection could go to. If this one is met down to there, if this one is met down to here, it will give projections down to here. That's the beauty of it all. You can do something like that. Again, don't get cocky with it, because until a projection is actually given and confirmed, you cannot count on it with a high degree of confidence. But that's what's happening with the Dow. Let's take a quick look at the S&P, because that's the one we follow most of all. On the S&P, it looks slightly different. And that's why you have to look at all the charts. The best time, the most confident time for projections is when basically all the important averages or indexes are calling for basically the same kind of move. So let's take a look at this chart on the S&P. So this was met today. This downside projection, which called for a close between 3201 and 3238, let's say, rounded off. Today's close was 3225 and change. So we met this projection. Do we have another projection as we met that one that gives us lower projections? Well, wow, look how close this is. Preliminarily, yes, but it's not confirmed. You need to get below the red line in order to confirm projections down here. If you do, then you're going to be talking about projections down to the low 3100s. This one, if we base it at just the breaking of the black line here, the initial offset, that will take you down to 3139. Again, I caution you, this projection has not been confirmed. Now, the other projection that we saw, it says that if we go a little bit lower on the S&P, and the Dow is saying we're scheduled to go not just a little bit lower, but quite a bit lower, then this projection will be confirmed, and it could take us anywhere down into this low 31,000 level, 31,001, 2, or 300. So, excuse me, 3,100, not 31,000. Talking about the Dow, 3,100 to 3120, 30, 40, in that area. So that's where we're set up in the market now, and it's exciting. And here's the most exciting thing about the projection software. Once you start coming down in the market, so obviously the most important times in the market and the times when you're most likely to be motivated to take a position would be like when I showed you that the S&P meeting that upper part of the projection as the Dow and the New York were meeting the lower part of their projections. that's kind of a place to be taking a position trade. Mind you, I'm not giving recommendations on these updates, and I'm not going to do that. I can tell you that we took positions with some of our managed accounts on January 22nd. That was the secondary high. Actually, it was the day of the all-time high on the S&P, but we got a turnaround. But when we met the upper end of that projection on the S&P, and the Dow and the New York were meeting well inside the lower end of their projections, those are the kind of position areas that you want to examine very closely. Again, we make no recommendations here, and we're not about to do that. If you follow the projections, you should have a pretty good idea, once you get a feel for it, where you might want to be taking positions based on these projections. Okay. Next week is going to be really, really important because we don't know. I'll talk about fundamentals for a minute. I'm not saying that this disease, this coronavirus, is not important to the market. It could be a catastrophe for the market and for world economies. But the stock market timing has nothing to do with that. The projection that was outstanding in the S&P at that number that we just came up to and nicked by 5 or 6 points, that was outstanding for 6 months. Longer than that, going back to March, April of last year. That knew nothing about any virus or any plague or health problem in the world. But we got up there, and now we've turned down. So if things worsen over the weekend, we could have a big downside gap on Monday. The Dow penetrated its 50-day MA today. The S&P is still above it, but it's not that far away. It's, 10, 15, 20 points at the most away from its 50-day MA. A lot of institutions might be lightening up if we get below that 50-day. Okay, I hope this has been helpful for you. It's been a long update, but it's been a long and very important week, and I hope you think that these cycle projections work just fantastically over the last week or two. And I hope you continue to watch. Thanks for watching this update. If you haven't subscribed yet, please do so. Subscribe and click the little red banner on the bottom. And once you do that, click the bell. You'll be notified of all the updates that we do as soon as they go on. Have yourselves a great weekend. Next week could be very interesting. Thanks for watching.